Most people entering the stock market ask the same question: should I buy individual stocks, or should I start with index funds? It sounds like a simple decision, but it shapes how much risk you take, how stable your portfolio becomes, and how likely you are to stay invested long enough to build wealth. For beginners, this choice matters more than most people realize. Index funds exist for a simple reason: they reduce risk. Instead of betting on one company, you spread your investment across many companies at once. That diversification happens instantly. You don't need deep financial knowledge. You don't need to time the market, and you don't need to constantly monitor individual earnings reports. This is why index funds are often considered the foundation of long-term investing. One of the most popular examples is the Vanguard S&P 500 ETF, known as VOO. VOO tracks the S&P 500 index, which represents 500 of the largest publicly traded companies in the United States. Its expense ratio is extremely low, about 0.03%. That means more of your money stays invested instead of being lost to fees. Over decades, that difference compounds quietly but powerfully. Another widely used option is the SPDR S&P 500 ETF Trust, known as SPY. SPY was one of the first ETFs ever created. It is also one of the most heavily traded ETFs in the world. Because of its size and liquidity, it closely tracks the S&P 500 with very little deviation. For many investors, SPY functions as a simple way to gain exposure to the overall US stock market. A third option often mentioned alongside VOO and SPY is the iShares Core S&P 500 ETF, or IVV. IVV offers similar exposure to the same 500 companies. It also maintains a low expense ratio and is designed for long-term investors rather than short-term traders. In practice, VOO, SPY, and IVV all serve a similar role. They give you broad exposure without requiring constant decision-making. This is why index funds are often recommended for beginners. They remove complexity, they reduce emotional decision-making, and they allow investors to focus on consistency rather than prediction. Instead of asking which stock will win, you participate in the overall growth of the market. However, some beginners prefer owning individual stocks, not because it is safer, but because it feels more tangible. Owning shares of a familiar company can feel more engaging than owning an index. When this approach is taken, experts usually recommend focusing on large, established businesses. These are often referred to as blue-chip companies. Blue-chip companies tend to share a few characteristics. They have long operating histories. They generate consistent earnings. They often pay dividends. And they are financially resilient during economic downturns. These companies are not designed for rapid speculation. They are designed for stability. Examples of well-known blue-chip companies within the S&P 500 include businesses like Apple, Microsoft, Johnson & Johnson, Procter & Gamble, and Coca-Cola. These companies operate across global markets. They sell products and services that remain relevant even during recessions. And they tend to recover faster after market declines. That said, buying individual stocks carries more responsibility. You must monitor earnings. You must understand business risks, and you must manage concentration. If one company underperforms, it can significantly affect your portfolio. This is why many investors combine approaches. A common long-term strategy looks like this. Index funds form the foundation. They provide diversification and stability. Individual stocks are added carefully and selectively. This approach balances simplicity with personalization. The most important factor is not choosing the perfect investment. It is staying invested long enough for compounding to work. Index funds make that easier. They reduce stress. They reduce decision fatigue. And they reduce the temptation to react emotionally. Wealth is rarely built through dramatic moves. It is built through quiet consistency, regular investing, low fees, long-time horizons. Whether you choose index funds alone or combine them with individual stocks, the system matters more than the asset. This is quiet economics, clarity over hype, systems over struggle.